Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, January 21st, 2022, with the Moose, John Mousseau, President and CEO, Director of Fixed Income. Tough week in the land of equities. John had it a little bit better, so I'll lead off. What are we looking at so far? Dow Jones down about 6% year to date. NASDAQ down, let's call it 12% year to date. So more damage continues to be on the growth side, although some value started to pick up a little catch up to the downside this week. We spoke in one of our meetings. I sent around an email. You got the feel this week that late in the day, and we hate seeing late day sell-offs, right? Capital wasn't rotating sector to sector. It was selling and leaving the market. You often need some of that to really spike fear. And in terms of what we're looking at in technical charts and so forth, I just want to pull up two quick ones. Remember last December 10th, not more than 5 weeks ago, we took a look at the worst performing index year to date. That's the Russell 2000. And you see it in front of you. Not too bad. Really a consolidation from spring, summer into fall. I had said if this can hang in there, we can be constructive on the overall market. If the worst index can hang in there, then the better indexes from a relative strength standpoint should be fine. When we flip to this second chart, you see today's view of that Russell 2000. Looks entirely different. You see the yellow squared box showing some of the action, showing this breakdown. Not the end of the world, but when we do have breakdowns out of long consolidations, we have to respect that there's a wind in our face. So when velocity really starts getting going and things hour to hour start gapping, what I like to do as a trader and as an investor is actually take the other side of that velocity and slow down. If you've raised cash, and I'll go over our strategies in a moment where we sit, but if you've raised cash, don't be so quick to buy every dip. At the very least, can we please see an up close before we get excited to put cash to work? So one of those scenarios you just want to keep in mind. Set targets of names you want to own. Maybe you own them and want to add to them. Maybe they're names that you've wanted to own for years and the market ran away from you. Set them up. I was talking to Moose about Microsoft. We own Microsoft and Tactical Trend. 6 weeks ago, trading at $340, went out today under $300. I go into next week not being afraid to add to Microsoft, but maybe I bid at 280, 282, 284 and see if that name comes to me. I'll own it there. I'll own Microsoft at 280 at 25 times 2023's earnings, growing at 20%, with a balance sheet that the government could borrow from. So you have to step back, slow things down, see what you want to own. Remember, we've been talking about growth and value all year. Notice what didn't get hit today. Utilities hung in there. Consumer staples hung in there. So you want to allocate properly. If you hadn't, just look forward. You can always adjust your portfolio. You haven't missed anything. The market keeps on trading. Keep your head. So in terms of our portfolios, a couple quick notes. Some of that fear, which was seen in both the options market and in some of the gaps down in the equity markets, we used to call those bids wanted, more on the individual equity side, but we saw some gapping, Moose, and that is a real fear indicator. What that did in Leo's strategy and Dr. Chen's market vol and leverage market vol strategy is create two buy signals this week, not just one. We got a buy signal Wednesday and Thursday. When you back together buy signals we've found in that strategy, it's had longer term success versus just one buy signal. Something to think about. So there is a good amount of fear out there. In terms of Tactical trend, we're sitting on about 22% cash. Didn't do any buying this week. Again, we want to see an up close. We want to see things get a little bit more, if you want to call it frenetic, to step in front of. Now, with the buy signal on the quant side, US ETF bought the S&P 500 on Thursday. So US ETF is fully invested. International, let's not forget about international. I've got to start hurrying up because Moose has some things to cover too. International, solid week. Who woke up international?
Right.
Who woke it up? Emerging markets, solid. Developed markets, weak but not horrible. Some of that money is searching for defensive areas or areas that haven't performed.
Right.
Some of that domestic U.S. money coming out. We'll keep an eye on it. Is that a long-term trend or just a short-term blip? We don't know the answer to that. The markets will tell us that. Moose, I've spoken long enough. Let's jump over to bonds.
I'll try to make this consolidated. This week, a little bit different than the weeks in the past where, essentially you've seen stocks reacting to higher bond yields, which of course been reacting to the inflation numbers. This week, bond yields down a little bit. The 30-year Treasury bond at a 208, down 4 ticks. Much higher during the week, up, close to 218, something like that. 10-year bond really unchanged at a 177. So this week, really, it was bond yields reacting to what was going on in the stock market.
Fear.
And fear coming in. And you're pretty sure this has happened because you look at the Muni market, and scales were cut by like 10 basis points.
When you say scales were cut, tell us what you mean.
To the scales, which are basically the marks that traders use for like a AAA creme de la creme yield curve, they were cut. In other words, put higher yields on them. So Treasuries pretty much flat or down a little bit on the longer end. Muni yields a little higher on the longer end. How is that supported? Supported by the fact that we saw over 230 million of municipal bond outflows this week. First time in many, many weeks we have seen outflows of the muni market. A lot of that in the high yield area. That's what you would expect to see. Really consistent with a stock market that's pretty choppy, is people taking money out of high yield. So we're watching for next week. Things like initial jobless claims, which were a little higher this week, and of course Omicron falls into that. And we also have next week Case-Shiller Index, which is the housing price index. The reason this is important as we go forward is that we have seen month to month pretty much higher prices, sometimes 1% a month, high prices in houses. How that feeds into the inflation numbers is a little complicated, but the fact is that prices have risen so much, the what they call owner's equivalent rents, as we know out there, are starting to rise. And even though we have the choppiness going on, we could still be seeing higher inflation. And of course, we think that as things settle down, rates will continue to move a little higher, along with the Fed finishing the tapering of their buying and probably raising short-term interest rates starting in March.
Okay, great, Moose. You know what I'd like to cover next week or even over the next couple of weeks? You mentioned high yield. We pay an awful lot of attention to high yield spreads versus investment grade or even treasury prices. And so far, we've been, on the equity side, we've been comfortable with the fact that high yield spreads haven't blown out. In other words, high yield trades what we call pretty dry, trades pretty well. Be interesting to see if some of this volatility starts to lead to a crack in that spread.
We're watching it.
Okay.
Right. So far, so good, but we'll see what happens down the road.
Good, good. Well, thanks for staying with us for an extended chat today. Don't forget to like, comment, and subscribe. Turn on your notifications and you'll always get an update, even if it's midweek from us. So enjoy the weekend. Get a lot of sleep. Next weekend will be just as volatile, I have a feeling.